Hello, everybody. It's Wes again. The 2-minute warning is over. So welcome to the latest in our series of webinars that we have been hosting for our society members. This has been a different way for us to get together over the last couple of months and learn about exciting topics. Today, we are going to focus our discussion on evolutions in responsible investing. We've got 4 panelists who are going to be speaking with us today. And we're thrilled to have so many registrants for today's call. This is a record. We've got 49 people who are signed up, so very happy to see that response. And I see the number of participants keeps going up as we chat. So very good. Thank you for your support. Hosting our panel today is Brian Mintz. He's the Vice President of Sustainable Investing at Addenda Capital. He has been involved in responsible investing and ESG factor investing since 2006 through his career. I first met Brian a couple of years back when Addenda was in Ottawa talking to us about their impact fund. I was quite excited about the initiative they showed in stating what they would expect from an investment perspective, so the performance of the impact fund, but also the ability to measure the impact they were having with the investment. And I think that was a novel approach the first time I'd heard something like that. And I really thought that was a innovative, thought-provoking way of getting some additional excitement around the impact that your investments can have in ESG. So with that, I will pass the call over to our host, Brian Mintz. Thank you, Brian.
All right, thanks a lot, Wes, and thanks a lot to CFA Society of Ottawa for having us all here today. I think all of us, myself and Erica and Sarah and Karen, are excited to talk with everyone today. And as mentioned, so the title here that we came up with is Evolutions in Responsible Investing. So what we're hoping to go through is kind of where we're at, get to where we're at today, but kind of go through kind of some of the terminology and the background that got us to where we are today, and try to cut through a lot of the language that we're hearing about. So ESG funds, sustainable investing, socially responsible investing. There's a lot of terminology being used these days, and we want to kind of cut through that, make sure people have a good understanding of what's happening in the industry and what sort of things you should be looking for as an investor in different funds and investment strategies when you're making decisions and allocating capital. So I'm going to start off with just a few introductory slides just to sort of help set the scene, and then I'll introduce our other panelists, and then we'll go into some questions at that point. To start things off, though, I believe there's a poll out there. We just want to make sure we have a sense of who's in the audience today to make sure we can kind of guide some of our comments towards you. So if you can fill out that poll, we'll take a look at that a little bit later after I do some introductions. And also I could see someone's already using the Q&A, but please do use the Q&A because we would be only too pleased to go off script and start to answer the questions directly from the audience. So we'll try to get to those questions as soon as we can. Okay, so I'm just going to have a look at these slides that we put together first of all. So first, I just want to start, this is a CFA Society event, so I wanted to highlight some of the work that the CFA Institute is doing centrally. And so this one here, I'm just highlighting a position paper that the CFA Institute put out not long ago. So it's positions on environmental, social, and governance integration. So what does the CFA Institute think that its members and people writing its exams should be doing? So first of all, there's a variety of statements in there and approaches, but underlying all of it, it's pretty clear that the CFA Institute thinks that all investors should be considering ESG factors. They're pretty unequivocal in that statement. And also, to allay some people's fears, they also say that considering ESG factors is consistent with fiduciary duty. So here's, a lot of the people on the call here are CFA charter holders, myself included. But here's that body that, we went through all those learnings, and there's a lot of research being done by the CFA Institute, but here they have pretty clear statements on what expectations are of CFA charter holders when it comes to ESG topics. The next one I wanted to highlight here is some recent work that the CFA has been doing to bring more clarity to sustainable investing, responsible investing, ESG. And so they put a consultation document out not long ago, and then there's going to be a committee working on some final recommendations for ESG related disclosures for investment products. And I wanted to highlight this because what one of the framing that they've used is to help provide clarity for investors of what is it that you're hoping to achieve with your investments when you talk about ESG. And that's the first column there. So things like, I want to be sure that my investment manager is considering material ESG issues that could impact risk and return. So that's the first item there. So that's something that I think most investors want, is underscored by that ESG position. But then you have other sort of wants and needs. So things like, so the next one, I don't want to violate my personal beliefs. So then you look across the top there. And so what ESG features do you want in a product? So if you don't want to violate your personal beliefs, then you're looking for exclusions. Or maybe you're looking for impact, but in particular, you're looking for exclusion. So they're trying to frame it up in a way that will allow investors to be clear on what they're hoping to accomplish with their investments, and then help them decide which ESG features they're looking for to help achieve those objectives. And then underneath that, there'll be some disclosure recommendations. So if you are doing ESG exclusions, you need to provide to your clients and prospects what things are being excluded and how are they excluded, so that there's clarity on what it is. Because we've heard a lot about ESG funds, for example, but they could have any number of these different approaches that you see across the top here. So what is it that you're actually buying? And then the last one, I would just highlight, there's lots of resources available from the CFA Institute. So be it climate change, ESG integration, equities, fixed income, broadly sustainable investing. There are a lot of resources there. There's some online courses available as well, and they're continuing to put out new research and information that's useful for CFA charter holders and everyone, in fact, in the investment community. And then the last one, I wanted to pull out some recent information. So just last week, the Responsible Investment Association published their annual investor opinion survey. So they go out and they ask investors in Canada for their opinions around sustainable investing, responsible investing, ESG, and so on and so forth. The one piece I just highlighted here, so they interviewed 1,000 investors. So these are people that are investing in mutual funds or ETFs, or they own stocks or bonds. And more than 70% are interested in responsible investing. And that's a number constant year over year. That's a big jump up from 2 years ago when it was 60%. And another important aspect of that is that number is very high from an interest perspective, but they ask another question, which is, has your financial advisor asked you about your interest in responsible investing? And that number is still quite low. That's more in the sort of 30% range. So there's still a big disconnect between what investors are saying they're interested in and what's being sort of put to them from their financial advisors. All right, so we've got some poll results here, which is good. So we have, I guess, about a third are investment managers who are here today. That's great. And then, unfortunately, about half of them have selected the other category. So that's all right, but there's lots of different people with lots of different hats, I think, that people are wearing. We're in these somewhat familiar to very familiar categories. So some knowledge here, which is great to see, and a lot of interest in ESG integration. So that's great. And then impact investing, which is a perfect segue into my first introduction, which is going to be to Erica. So I'm going to stop sharing my screen here. So first up, I'm going to introduce our panelists. So I'm going to start with Erica, very brief introduction, and then she's going to talk a little bit about her role and what she's up to. So Erica is the Director of Solutions Finance at the McConnell Foundation, and she oversees the $100 million plus impact investing portfolio that the foundation has, as well as ESG integration work for the rest of the foundation's assets. So she's looking at impact and ESG integration work. And I'm going to turn it over to Erica to round out that introduction and help people understand where you're coming from.
Thank you very much, Brian, and lovely to be here with everybody. So as my department essentially, as Brian was saying, oversees the management of the impact investing portfolio along with our investment team. and responsible investing. At McConnell, we've been doing impact investing since 2007, and broadly across a spectrum from concessionary type investments where it's high impact, some concession on the returns, to impact and high and market rate returns across asset classes and across a range of domains, which I'll go to, I think, a little bit more later in the talk. We're committed to moving 100% of our assets into and manage them under some form of responsible investing, in the process of building that strategy at the moment. And we also have a portfolio of what we call field building initiatives. That's primarily funds from our granting side, where we're supporting intermediaries and work across Canada that are helping build the market of sustainable finance more broadly.
That's great. Thanks, Erica. We're really happy to have you here today. Next up, I am going to introduce Sarah. So Sarah is a principal at ESG Global Advisors. This is a new, relatively new, I guess at this point, not brand new anymore, but a new consultancy that works at the intersection of investors and companies focused on ESG topics. So with that, Sarah, I'll turn it over to you.
Thanks, Brian, and thanks to the CFA Society Ottawa for having me here today, and to all of you for your interest in this topic. So a little bit about me. I'm a chartered accountant by background. I've worked in both the energy and mining sectors in the past, both as a financial statement auditor and as a consultant. I have deep expertise in climate-related risks, strategy, governance, and disclosure. And at ESG Global Advisors, we're really focused on bridging the gap between companies and investors on ESG topics. And that includes a deep focus on climate change, which is a growing issue. And I think we'll talk a little bit about that today. We take a multidisciplinary approach. So we're a team of lawyers, accountants, CFAs, and environmental scientists. For our investor clients, we do everything from internal ESG education for senior management teams, as well as portfolio managers. We help investors establish and update their processes to integrate ESG factors into their investment and due diligence processes for selecting and monitoring external asset managers. And we support them with their reporting to clients and beneficiaries. On the corporate side, we do a lot of ESG education for senior management teams as well as boards of directors. We perform ESG materiality assessments to help companies prioritize their ESG factors. We do benchmarking against their peers, as well as doing deep dive into what their top investors are looking for from these companies. And of course, we help them with their external reporting, not only to their investors and the capital markets in alignment with SASB and TCFD frameworks, but also reporting to their broader stakeholders. And last but not least, we also help companies establish robust climate change and ESG strategies for their organization.
That's great. Thanks, Sarah. It's a very interesting position to be seeing both the investor and the company side of things. And then the last panelist that we've got here is Karen Lockridge from Canada Post Corporation Pension Plan. So she's the director of ESG investing there. And in that role, she's responsible for developing and overseeing the pension plan's ESG investment strategy and risk management framework. Karen, thanks for joining us.
Great. Well, it's great to be here with you all today. So I'm fairly new to Canada Post. I joined December last year. Well, I guess it's coming up a year. And before that, I spent over 25 years at Mercer. I have an actuarial background, but I spent the last 3 years at Mercer on the responsible investment team. And the role that I'm in at Canada Post is a new role for the pension fund. And this reflects an increasing focus on ESG and sustainability across Canada Post Corporation. So our corporate sustainability team has been really ramping up our strategy over the last couple of years, and I'm working closely with them. Canada Post has actually 2 retirement arrangements. Our largest is a defined benefit plan. It's about 27 billion of assets under management. We also have a defined contribution plan. It's about 90 million, so it's smaller, but we became a PRI signatory this year, and our status, PRI signatory status, covers all of our retirement arrangements. So 2020 has really been a capacity building year in terms of our ESG and responsible investment strategy, starting mainly with the retirement arrangements. And I'll, as we get through it, talk a little bit more about how we've approached that. But what really attracted me to Canada Post was the commitment at the corporate level, and I think we're seeing that as a theme, you know, across many different organizations and different sectors.
That's great. Thanks, Karen. Thanks for being here. Okay, so what we're gonna do now is we got a few questions that we've been thinking about as a panel beforehand, but also I see we're starting to get some questions. We have some questions that came through on the Q&A, and I'd encourage others to ask some questions as well. And I'll try to weave those into our conversation here. I think I'll kick off though with a question for Sarah. So as I mentioned, I kind of went through some terminology myself, but there's a lot of different terminology being used around in responsible investing. We're seeing ESG, integration, stewardship, SRI, impact investing. There's just so many terms and different ways of thinking about this. I'm wondering if you could sort of highlight some of the key terms and provide some clarity, I hope, maybe on how they're being used and how they should be interpreted.
Perfect. Thanks, Brian. So if you are able to put the slide up on the screen, I will talk through kind of the 4 big buckets in the responsible investing, also called the sustainable investing universe here. So on the left-hand side, you see kind of the typical fund. Of course, that's financial return driven by traditional factors. And one of the points I want to make on this particular piece of the spectrum on the far left is that in 1975, about 83% of companies' assets were tangible. You know, fast forward to 2015, we see the inverse is true. 87% were intangible assets. Therein brings us to the next strategy here, which is ESG integration. This is really all about financial return being driven both by financial and traditional financial factors, as well as non-traditional factors, and that includes environmental, social, and governance risk. When you see a lot of these large stats about how many investors are employing responsible investment strategies, the vast majority are falling into the ESG integration category. So just keep that in mind. So really, this is all about enhancing investment returns by adding an additional lens to better spot investment risk and opportunity. And it requires a consideration of material ESG risks and opportunities as part of your traditional investment process. So this does not limit the investment universe. There is no negative screening with this approach. And stewardship is an essential component of ESG integration strategies. And that's really 2 components here, looking at engagement with companies, as well as proxy voting. And then, of course, there's also the influence with policymakers. Moving on from ESG integration, you see SRI, or socially responsible investing. This is what many think of when they hear the phrase ESG, but I just want to remind everyone that this is not the largest segment of the responsible investment market. Some of the related terms for SRI are things like screening, ethical investing, fossil fuel free, values-based investing. This is where you're actually having a constrained investment universe, meaning you're avoiding certain sectors that do not align with your values. So this does have the potential to negatively impact returns because you are limiting the investing universe. And that all depends on the breadth of these types of exclusions. In addition, there's no ability to drive change through stewardship activities such as engagement and proxy voting because you're simply not holding the securities that you've screened out. And on the far right, we have impact investment. This is a small but very quickly growing segment of responsible investment. And certainly, as Brian noted in the introduction, the pandemic has increased interest from investors, both retail and institutional, for more demand for impact investment. So this is really looking at investments that have a positive focus on environmental and social change. They may exclude sectors or focus on specific themes such as low carbon, for example. There is potential for below market returns depending on the focus of the fund, particularly depending on the level of exclusion. It initially began in private markets, but it's certainly expanding to public market. However, as I noted, it's a growing and budding area, and I think our colleague on the panel, Erica, will be able to speak to the rapid growth we're seeing in the impact investing space. So with that, Brian, I'll pass it back to you, and I hope that level setting on terminology is helpful for everyone.
Yeah, that's great, Sarah. Thanks so much. So, you know, as you see there, there's such a wide spectrum of approaches And as I keep saying over and over again, there's a lot of confusion about what it is you're actually getting when you talk about ESG fund, and you know, that term ESG fund probably may not be appropriate at all, really, because it's so all-encompassing and has so many different factors to it. But if we turn our attention from sort of the what back to the why, if we think about why, you know, why are people doing these different things? And Erica, maybe you can provide some comments on that. Like, there's lots of different things that you can do, but why might you do those different things? And how do you sort of fit those together between what you want to achieve and then what you're looking for in an investment product?
Yeah, I think you got a little bit at that in the table that you were presenting, Brian, with the different options. The motivations of investors are, you can probably see it broadly in three categories. Sort of like, okay, this is from a value standpoint. I want to be investing things that are aligned with my principles and my values, and then you choose certain types of strategies. You want to mitigate risk and enhance returns and look for opportunities. So it's mostly about competitive returns of your portfolio and acknowledging that ESG factors are important in that. And or you want to contribute to solutions, as it was said. In terms of why investors are moving in these different directions, it ranges, you know, from changing demographics, but this is not just millennials that are asking for more values-driven companies, investment management, etc. We're seeing institutions like mine, for example, foundations and endowments. It's all of those motivations. We want to be, it's just about institutional integrity in terms of what our organizations are about. And we're seeing really a growth in uptake of these strategies by many types of institutional investors around the world. If you look at just the US market, I think early this year, it was estimated at $12 trillion were managed in some form of responsible, sustainable, or impact in investment strategy. So that's about 1/4 of total professionally managed assets. And it's not just about the products that are invested in. I think, as Sarah was saying, stewardship is a very big part of it, and we're seeing investors participate in sustainability-focused coalitions where they interact not only with companies through their investments, but also with industry and policymakers, understanding that we actually want to contribute and be more active in actually protecting the state of the world and driving sustainability in a way that's going to make sense for society, for the financial markets, for communities, for the environment, and everything together.
Great, Erica. Maybe if I could pick up on one piece that you said as well, I think is multiple objectives. So it's not, you know, it's not one or the other, but you can be seeking, you know, your investment returns and positive impacts as well. Is that something you're able to be doing with the foundation?
Absolutely, and I think that's where, and it might be one of the questions that I was reading there in terms of at what level do you look at this integration, and it's, yes, you can embed this at the product level, but the importance of actually understanding your stakeholders and your clients and the asset owners and their motivations so that you can actually tailor the right approaches to achieve those objectives. And for the most part, you're going to find a combination of motivations, not just one. At least it's been my experience in conversations with asset owners.
Right. Okay. Great. Thanks, Erica. And now a question for you, Karen. So I think part of that and part of that question I just asked, but there's a lot of like myths and sort of feelings or thoughts people have that are holding them back. Are there any sort of, you know, in your many years with Mercer before moving over to the asset owner side, are there some key myths and are there certain ways that we can address them and sort of get them out of the way finally?
Well, I would say, you know, it sort of picks up on what Erica was referring to in terms of these broad trends. There's, you know, these broader trends around, you know, move to a broader stakeholder perspective, new information, increasing disclosure. I think a key part is sort of mindset. You know, like one common myth is, you know, ESG is negative screening. I mean, that was sort of some of the first comments that I got when I joined Canada Post. Okay, does this mean we're going to, you know, do negative screening? And I think part of it is just taking the time to understand how the world is changing, and that, in fact, taking a broader perspective can sort of open new ways of looking at things. The other one would be around, like, we're already doing this. We've been managing money for quite a while. We're already looking at, you know, all relevant financial information. So it's looking about what are the regulatory trends, consumer changes, technology developments, what are the structural shifts that are going to be playing out. And then around fiduciary duty, I think the PRI has and the CFA has done a lot of work in terms of clarifying that, you know, investors should be taking into account the broad range of information. The PRI is also now looking at the concept of impact, so the legal framework for impact. So I think even on fiduciary duty, although it's quite clear that investors should be looking at a broad range of information, I think there's going to be a continued evolution, even in the how we look at fiduciary duty going forward.
Thanks, Karen. So it's yeah, we have a recurring theme of terminology being a barrier, where people say responsible investing and they think, oh, you mean we're going to screen certain sectors out, when really we may mean we want to better consider material ESG factors, or we want to be better stewards of our investments in the hopes that that will result in better risk-adjusted returns for our beneficiaries. Yeah, it's a key, you know, it's going to be hard to solve or have that conversation when two people are thinking two different things about something, for sure. I'm thinking, just looking at one of the questions that we have. So it was a question around the success. So I think we've all seen the headlines this year of ESG funds. On the one hand, we've seen a number of articles around how they've outperformed this year and they've done really well. And we also have a number of articles about how there've been huge flow of funds into these funds as well. And then you have recent studies. The question is around recent studies around sometimes performance is good, sometimes it's bad. Is it perhaps the big tech stocks, and that maybe some ESG funds are overweight tech, for example, or you know they happen to be overweight tech and they happen to be overweight healthcare as we went into this pandemic, so maybe that's a driver. So is there a third driver that's not actually ESG related, and so on. So does anyone, I'm looking at you, Sarah, but does anyone want to jump in and sort of offer some commentary on that big flow of funds? And is this indicative of how we hope or think things will go into the future?
I'm happy to kick things off. So, I mean, ultimately, I think this really comes back to the definition of the different approaches under the responsible investment umbrella. So we know that ESG integration accounts for the majority of those flows. So that's always something to keep in mind. And it's being done really well by some investors and maybe not as integrated by others, right? So I think it's really important to take some of these stats with a bit of a grain of salt. But I think the overall directional trend year over year is clear that there is kind of exponential growth in terms of funds considering ESG factors and the desire for more and more of these products. So ESG definitely isn't going away in this increasingly interconnected world that we find ourselves in. And I think the pandemic has certainly highlighted that. I think one of the key things here is it's really important for you as investors to really clearly define your ESG investment strategy and your criteria. So coming back to those features that you outlined at the outset, Brian, from the CFA Institute. And then on top of that, transparency is critical because we're seeing growing accusations of things like greenwashing in these funds. So I think it's really important for investment products to be really clear about what the ESG features are and then how they're implemented in the selection of underlying securities. So to your point, Brian, certainly we've seen ESG exchange traded funds outperforming in the pandemic. And their largest holdings are tech stocks. They tend to underweight fossil fuels, which of course have been impacted by the oil price crash, and overweight things like tech and healthcare. Now, these don't necessarily, by many standards, have strong ESG performance. You can think about privacy issues with Facebook, the growing advent of fake news, energy consumption and GHGs associated with data centers, the packaging and shipping and single-use plastics we're seeing spiking. So really the message here from my perspective is be really clear about what is involved in the investment strategy and transparent with those who are selecting those securities.
Yeah, that's great, Sarah. I think, yeah, looking under the hood. So, you know, I get people, colleagues, people from outside my organization send me emails and, oh, look at this, isn't this fascinating? And then I think it's important to look under the hood. So like a recent one came from a broker and it was showing all this huge growth. And then you look under the hood and you see, well, what actually are these ESG funds? And it's, yeah, a full third of it is ESG integration only. A third of it is just some rudimentary screening, and then you have some thematic and sort of more nuanced approaches rounding out the rest. But it is important to look under the hood and get a sense of what it is that people are actually categorizing as ESG at this point in time.
And also, Brian, if I may, I think that it's also a matter of how you're setting your expectations. ESG integration is not going to be the criteria that by its own is going to determine whether your fund is going to outperform or not. At the end of the day, it's really about having a much more complete understanding of drivers of the value of companies, of markets, and the context in which these companies are operating. And so it's almost like, of course, you know, at least from my standpoint, you want to have the fullest picture to do a proper assessment, and then the actual performance of the funds is going to be driven by many other factors that are complementary and in addition to the ESG screens that you're putting in place.
Yeah, absolutely. Okay, we're starting to get more questions from the audience, which is great. So we will reinforce that by starting to answer some more of those questions. So we have a question here about what do we think about the largest ESG reporting providers? So groups like MSCI ESG, Sustainalytics. We've got some, you know, other reporting providers and analysts and analyst companies that have been acquired by the credit rating agencies and so on. So is anyone, you know, you don't have to name names, but on the panel want to speak to their experience with a service provider and sort of where you see the most value out of that process and where you're maybe looking for better information? If not, I can start to answer that. And maybe Sarah, you can comment on it from a company perspective. So we, you know, at Addenda, we use some of this ESG information that's provided from these service providers, but it's not, it's a starting point and it's one piece of information that we can factor into our decision making. And I think what I've heard other people use as sort of a corollary is if you are on the buy side and you get lots of sell side research, you have multiple people writing about a company and they're each having their own take on the company, and whether they have a target price or a buy or a hold or whatever recommendation, not very often a sell, but you have a different way of evaluating companies, and you have lots of different ways of looking at and using the information that's available. So each of MSCI, Sustainalytics, Vigeo, Iris, and so on, they each have their own way that they've over time developed to evaluate the information that's available to them. And then they, you know, it's an interesting input into a more fulsome process. So it can highlight, for example, controversies or where a company is really not disclosing around an important topic. But in and of itself, we don't think there's enough information value in a single provider to build a whole portfolio based on what they're telling us. So that, you know, whether it's a numerical score or a letter score, it's not enough information in isolation to build a portfolio with. I don't know if anyone else wants to add on.
I can offer from the company perspective. Certainly, I would say that the growing number of ESG ratings and research providers out there is definitely getting the attention of corporates. Increasingly, companies are paying attention to their ratings from the likes of MSCI, Sustainalytics, and ISS ESG in particular. And I think, part of this is twofold. First of all, they're concerned about their investors' use of these ratings. So they're aware of the trend. And certainly in my prior role at CPA Canada, we had done some research with institutional investors and found that all of them are purchasing this research from these third parties, but they're not taking the ratings at face value. To your point, Brian, they're taking it as one input to the investment process to analyze ESG factors and reaching their own conclusion on what's most financially material. On the corporate side, I think the concern is around the growing number of ESG related passive investments and really these ratings being used to construct indices. So you're starting to see more and more the ratings having a direct impact on access to and cost of capital for companies. And I think the challenge for companies is that each of these rating agencies has their own methodology and they are different. They place different weighting on different ESG factors for the same company in a given industry. So I think it's important for companies as well to look under the hood of their methodologies and make their own assessment for the company on what's most financially material and communicate that clearly to their investors.
Yeah, that's great. Thanks, Sarah. I think that's a good perspective to have from the side of the corporate issuers. Just continuing and looking at some of the questions that are coming in. So there's a question here. What does the panel think about divestment versus engagement? And then they're thinking in terms of from a smaller investor point of view. So does anyone want to jump on that one? I certainly have a comment, but Karen, do you want to take that one first?
I can start. I think first of all, it comes, starts with a level of conviction or theory of change, or the investors' views about these risks and opportunities and where they have leverage. I'm assuming that this is in the context of fossil fuel companies, but shouldn't assume. But it often comes up in the context of climate change. And I think on climate change, that does require sort of a broader perspective. It's it's not just one sector that needs to change. So I think both have a role. Although if the investor is going to have an impact, it requires a certain level of conviction about what the risks and opportunities are and how they're going to be implemented. I think both can have a role.
And I think, Karen, you've got a good point there in terms of the theory of change. So what is it that you hope to accomplish through your action? So if you hope to put an end to the fossil fuel industry, but how do you hope to achieve that? How will could divestment help you do that? Or how might engagement help you do that? Or if that's your hope, as you say, looking at one industry alone, but there's the consumers of the product as well. So there's lots of complexity, but being clear on what it is you hope to achieve with that particular action. So which ESG feature, if you call divestment a screening feature, what is it? What need are you hoping to solve by having that feature? Or if it's better stewardship or more focused stewardship, what are you hoping to achieve with that? I think, and being clear about that first, and then picking the features you want to help achieve that. I think I'll keep on this trend though. So there's another question in here about, so the question is, can you be an ESG focused investor if you own fossil fuel midstream assets and are working to make them cleaner? So I don't know if anyone else wants to jump in on that one, but I think it kind of dovetails nicely with that last question as well in terms of, oh, Sarah, did you want to jump in, or Erica for that matter?
Go ahead, Erica.
Thank you. I certainly think so, that you can, if your interest is in sort of like promoting transition, and you have it right now, you can do shareholder engagement through your equity portfolios. You can look at now what's growing as transition based bonds, similar to the green bonds, but more focused on actually helping some of these companies move in that direction. At McConnell, we had chosen at one point we had minimal, but still some stocks in fossil fuel companies in Canadian companies, and we chose to stay invested through managers that had very strong shareholder engagement, not only on environmental issues related to to climate action and sustainability activities, but also engagement around their work with communities, most of which were Indigenous communities, which is also a priority for our organization. And so from that standpoint, being able to engage with companies that were operating in territories of communities that we were also supporting through our grant making made sense from a just sort of like adding layers of impact, if you want, through our various assets. But it's a not open conversation all the time, and sort of like at what point do we want to divest or not, and now for other reasons we might choose to in the future decide to divest entirely from fossil fuels if the engagement no longer makes sense for us.
The one other comment I would make about the question, there's a reference to working with companies to make them cleaner. I think an important part of engagement is, getting clear on what the expectations are of the company. I think Climate Action 100 Plus, which is a global collaborative initiative, focused on the top 100 emitters and other companies that are significantly important to the transition. There's very clear expectations in terms of, governance, disclosure, and now net zero by 2050. So that would be the other comment I would make. It relates to the theory of change, but just being clear in terms of expectations. And there's increasing, reliance on, at least in the climate context, science-based targets, although now we're seeing that extend into nature-based solutions and deforestation challenges.
Thanks, Karen. Yeah, I agree. And I'll just pick up on the question a bit more. So I was saying in the context of a concentrated private portfolio. So I think it's at the risk of sounding like a broken record, it kind of goes back to like what it is that you're hoping to accomplish. So if you already have that portfolio, then you can still apply responsible, sustainable investing approach to that portfolio. So in terms of the stewardship of it, but if you have an ethical reason for not wanting to do it, then that requires a different approach, like a screened approach. So again, it goes back to like, what are you hoping to accomplish? If you already have the assets, then it's okay, what do I do with this portfolio now that I own it? How do I monitor their performance on these important things that I think are important, both financially and important to the organization or to the ultimate end beneficiary? And what can I do about it from a stewardship sort of perspective? We've been hearing a lot about and engaged in the dialogue around transition finance. So we know we're engaged with this Canadian Standards Association is helping do some work around putting together some transition finance principles and taxonomy. That's ongoing work. I think it's a vital piece of work that's happening in Canada to help move that conversation forward and be focused on, and I think Karen, you touched on it as well. What is our end objective here? I think, if our objective is, a net zero emission society by 2050 so that we can meet the goals of the Paris Agreement, then when we're having those sorts of engagements, then that's what we should be talking about as being the end goal and being clear on what it is we're hoping to achieve. Because I think even in the question, cleaner is in quotes, and it's like, how do you define cleaner? Well, if you know where you're trying to get to, then you can start to piece together your path to get there and look for activities that are going to get you there over time. Let's see, maybe I'll switch gears a little bit because we did have some definite interest in impact investing. So if we spend a bit more time with you, Erica. So I wonder if you could just to illustrate the concept a bit more. So just to clarify for people sort of what your definition is of impact investing. And then if you wanted to share just a couple of examples of what is in the portfolio that you've helped put together at McConnell, that'd be great.
Sure. So impact investing, I think the standard definition that has been adopted, the point in 2010, which is the one that we hold, is that it's investments that either directly into organizations, companies, projects, or through investment funds that are intentionally seeking to create a positive social and environmental impact in addition to a financial return. And so, you know, in the earlier days, there was this open question of what are we talking about here? And is this sort of like very, very niche market? Is this really about bringing private investments into the nonprofit sector, social enterprises, B Corps, and social enterprises? We've, over the past 10 years, been exploring and really in a responsive way looking at how you may or may not do impact investing across a range of asset classes. And so the way that I would characterize it is just you're adding that additional lens and looking at not only the outcomes in terms of solutions and impact on the world, but also the integrity of the process of managers. We invest only through external managers. So looking at how they select their investments and making sure that what we're looking for is a measure of change in something socially or environmentally. And that can be, you know, it spans an entire spectrum. You have, on the one hand, those that are closer to the philanthropic side, where it is investing in more subsidy requiring sectors, affordable housing, loans to nonprofits, and this new field of pay for performance contracts, social impact bonds, and those types of things. So we have some of those in our portfolio. We've been doing investments in indigenous communities for expansion of home mortgage lending and home ownership renovation lending in unreserved communities. But we also have on the other side of the spectrum, investments in private equity and public equity, fixed income that have all the characteristics of non-impact mainstream asset management. And we have portfolio of, and more mature areas, portfolio of green bonds, where it's a corporate and government green bonds, and manager is a highly qualified team with climate specialists that are able to actually look and understand ultimately the use of the proceeds and ensure that it's going for green infrastructure development for the most part. We have a renewable energy fund that is global, also through a very one of the largest mainstream managers. And we have a whole range of private equity funds, and most of those are investing in B Corps, so companies that get a third-party certification that, in addition to the business, they're also either have environmental, social, and governance policies in place, labor policies, etc., but are also contributing to some impact in their community. So I would say you have quite diverse, huge diversity in terms of rates of return and concessionary versus market rate, as well as a whole range of domains in which you can invest. And it's not either ESG or impact. What we're seeing more and more is it's both, and you can aim for both. It really depends how far you want to go in that contribution to solutions.
Right. No, that's great. Yeah, it's such a wide variety of opportunities out there now, and just growing really quickly in terms of the offerings we're seeing from a whole number of different providers. So as you said, some of the most sort of mature and quote mainstream investment managers now are rolling out some products that might even be suitable for an impact investor.
And there's and I'll maybe just add, there's something that has really helped in terms of the framing is the alignment with the Sustainable Development Goals, as well as the 1.5 or 2 degree scenario through the Paris Agreement, and seeing how investment managers are starting to align some of their products with those two objectives.
Right. So that sort of clarity again of purpose of these are challenges that exist, and how can we invest to try to get and solve those challenges, and also earn a rate of return as well.
Yeah.
That's great. Okay, we got a few minutes left. Maybe a couple of, Karen, go ahead.
Brian, can we just go back? Andrew put in another sort of follow-up question, which I just wanted to briefly refer to in the context of if an investor is, invested in a third-party fund where, you don't have control over the assets, which at Canada Post, about half of our assets are managed through external managers. So what I would suggest in that case, or what we have done, is we've done a survey of our external managers, an ESG questionnaire, asking them about their policy and philosophy, ESG integration approach and stewardship, and really looking for, how robust is their thought process, how far along are they on this evolution? That's the title of this session. So I would just, in this particular case, it's an ESG manager, but they still buy a midstream at a, target cash yield, ask them about, how did they reach that decision? And, how are they looking at potential risks going forward or opportunities? So it's really, looking for the level of conviction that the manager has and hopefully influencing the manager, or, over time, maybe finding that investing in that fund is more risk than is worth it.
As for us, as we started to just communicate to our managers that we want, and we started to do that questionnaire of just ESG practices, we were just trying to understand the baseline of activity with our managers. Mm-hmm. Some of them actually came back to us and said, "Oh, we didn't know you were interested in these. Here's alternative, or here's an option that is more aligned with what you're looking for." But it's useful to just have that conversation, and based on the baseline and even understanding the types of products that you're in, then you might actually see that there's, without changing much to your current policies or strategies, you can already move in the direction of more responsible investing.
Oh, that's great. And I would just, as an investment manager, nothing gets my colleagues motivated as much as questions from clients. So, I'm passionate about this. I think it's super important, and I'm pushing it all the time internally. But when we get more and more questions from clients about these things, it really spurs innovation and gets people really, putting their full weight and thought behind it. So, even simple questions can really motivate sort of acceleration of change and adoption of new practices. So don't hold back. We're nearly at time, so I'm gonna ask one more question, and this is, and then I'll ask each of you a 30-second question. But first, I just wanted to sort of say, what is a key issue right now that you're spending a lot of time on, or you're getting a lot of questions about, or is really concerning to you, in your own work at this time? Anyone?
I can kick things off, perhaps. So I would say both with our investor and our corporate clients is the issue of climate change. And I think the question has certainly been raised, and there's been much written on it around whether or not the pandemic enhances or diminishes the importance of addressing climate change. I would say in terms of the trends that we're seeing, it's actually enhancing the focus on it, and also recognizing the link between climate change impacts and pandemics, and the likelihood of pandemics to happen in the future as we experience a warming world. What we're really seeing a lot of is companies trying to figure out how to provide their investors with that scenario analysis that's required by the Task Force on Climate-Related Financial Disclosure. The reason the TCFD has become such a catalyst is because, of course, it applies both to investors and to companies. So we're increasingly doing presentations for our investor clients, asset owners, and asset managers around what TCFD adoption actually means, how they can start to do some of this initial disclosure, and what that kind of journey looks like toward moving to more quantitative scenario analysis as data and methodologies improve.
That's great, Sarah. And I would just highlight, I think it was overnight, TCFD put out their report on updated sort of what's the status of disclosure around the world. And I haven't even looked at it yet, but I think they put out some guidance to help with scenario analysis. So, okay, we've got just a few minutes left. Does anyone want to chime in with any other topics before we go to our last 30-second speed round question?
I would say diversity and inclusion. I mean, I echo Sarah's comments about climate change, but the one topic that I'm getting the most questions from our internal stakeholders is around diversity and inclusion.
And that seems like very common across the board. We're hearing about a lot as well. We've got the Responsible Investment Association has their Diversity and Inclusion Week on right now. I hope that some of those sessions will be made publicly available, because there's been some pretty great speakers with some pretty eye-opening information. So hopefully that will get out there. Okay, should we go to our lightning round? So last question. So it's not much of a question other than what one single thing, so you got about 30 seconds, it looks like, each of you. What's the one single thing you want this audience to take away from the discussion today? And I could start. Who should I start with? Anyone want to go first?
I can go.
All right, Erica will go first.
The one thing that I would say is that really, you know, you have a huge, it's an entire spectrum, and you have a whole range of options where you can start on the more proactive side and impact investing, and there's an entire spectrum within that, or the more passive responsible investing and with screens. And it's such a diverse set of approaches that just by looking at your current policies, your current governance, there's surely a place where if you're interested in this space, you can start and then from there progress. So I think that there's compatibility for every type of investor and every type of motivation.
That's great. Thanks, Erica. Sarah, do you want to go next?
Sure. I would just say, you know, building on that, regardless of what your theory of change is in that spectrum, increasingly the world in which we invest cannot be separated from the society in which it operates and the environment upon which it is dependent. So this is not a fad, but this is much more a reflection of an increasingly interconnected world, and this is not going away. So it's great to be having this discussion today and to have had a record number of registrants. It just shows the importance of this topic.
Yeah, for sure. Thanks, Sarah. And Karen, one thing?
I would just say, for the reasons that Sarah just articulated, I mean, for me personally, from a career development, professional development perspective, this has been, you know, this whole sustainability space has been a real eye-opener for me over the last, you know, 5 or 7 years. And for me, it's been a whole sort of breath of literally fresh air, you know, in terms of my career. So I think this is, you know, for people looking to get, you know, excited about their work they're doing and the impact they're having. You know, there's lots of opportunity in this space.
That's great. So there you have it. So get started, do something right away. This is a trend that isn't going away. And by the way, it could be good for your career as well. So
For your soul.
and for your soul, definitely for your soul, most importantly. So thank you, Sarah, Erica, and Karen for joining us on this panel today. And I think Wes is there, I think, just to wrap things up for the CFA Society of Ottawa.
I am still here. That was fantastic. Thank you, Brian. Thank you, Sarah. Thank you, Erica and Karen. That was very engaging, easy to follow, understand, and stay committed to being involved in the discussion. And I think the having the active participation from all those who hopped on the line, that helped as well. So thank you very much. Our next session is on November 18th, where we'll be look forward to having an equally high number, maybe not a new record, but an equally high number of participants at that upcoming webinar.
Thank you.
Thank you so much.
Thank you.